Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, October 7th, 2025. I was going to just pick it up tomorrow, and I was catching up on the comments, replying to any questions or comments, and somebody asked if I was going to do a closing market wrap so they can prepare for tomorrow. Absolutely, and I wasn't planning on it, but I'm going to do it now. Here it is, just because. As I like to say, things can move very fast or change very fast in the market. We've had what seems to be a bulletproof trend that's going to go up forever. And as I said earlier today, I'm not going to say I haven't seen almost identical patterns in the market, even before, the late 90s heading into the dot-com bubble. But and we've had resilient trends, many of those over the last couple decades. And again, so you have, I'm just seeing lately analysts after analysts, kind of even some of the perma bears capitulate and calling for that blow off top scenario. So let's just be flexible and ready. And here, I'll address that. Let me get to these comments, and you'll know what I'm talking about being prepared for the unexpected if it happens, and then positioning quick. So I'm just going to go to these comments. This is from the latest post here. I'm going to zoom in a little bit. And I'm going to start here. So kind of in no particular order, these are the questions that have been asked. Great questions, in my opinion. This is from the video earlier today. Kevin said, looking at the chart of BIZD over the last 3 years, every time the RSI got down to the 30 area, there was a major rally, especially when it went below 30. Blah, blah, blah. So the site, in other words, he cites the technical evidence that shouldn't a big rally be imminent again. And so, and I'm going to go through these right now. I'm going to get to some of the individual private credit companies, business development companies here. And so, as I said, and yes, quite a few are at or near support, oversold. We even have a divergence on have divergence building or already in place on a lot of those. So 110%, I can make a case for a rally there. And I'll say it, and this isn't, I'm not trying to be facetious or anything. Absolutely, if you like it, step in. There's nothing wrong with ever stepping in to buy a security you like on a pullback to support, especially when you have divergences and potential selling climax. And again, just don't fall in love with it. That's what stops are for. I happen to think, again, I've been warning it before it started happening. Now it's happening. This kind of accelerating. I'm not going to use the word implosion. I think that might be a little too strong. But again, you've seen the charts. A lot of these stocks are going down. And the point that really I would try to impress, that gives me pause for wanting to go long, again, it's just something to watch right now, is if these companies aren't making money at the stock market at an all-time high, corporate earnings are still up there, even though, of course, let's not get into the whole nitty-gritty. We know that valuations are at or near, or even in some cases above some record levels, if you're looking at, different valuation metrics. But with that being said, God forbid, God help these companies if we have a good old-fashioned bear market or recession. Because if they're trading like this right now, when everything else is whizzing and humming along, and a lot of things at or near new highs, a lot of sectors, then what's going on here? So again, let's not beat a dead horse. I've said, there's a lot here, and that's why it's called private credit, just like private equity. It's kind of akin to a Ponzi scheme, if you will. Madoff was chugging along and doing great, living a great life, making a ton of money until kind of, I guess the markets expose. The markets go down, you start getting redemptions, and sooner or later that's kind of exposed. And private credit, I believe, and I think this is systemic to just risk in general. Even the public credit markets, I've talked about it. Jamie Dimon and people much smarter than me in that aspect have talked about it, that they don't believe that the markets are accurately pricing in potential risks. That's what credit spreads are all about. Either actual current risk if companies are defaulting, or potential risk. In other words, if something just kind of things take a hiccup or a jog in the wrong direction or something unexpected. I'm going to get to that as well in a second here. So with all that being said, we're going to rifle through these. And yes, and I mean what I'm saying here. If you like it, go with it. Kevin, you've been very vocal. You believe the market's got a lot more upside to go. So if you're bullish on the stock market, you can have a pretty, long, aggressive, be in the high flying stuff, the Nvidias of the world, anything related to AI, and have that in there, and then maybe step in and buy these BDCs right now, because if this market has a lot more to go, a lot more upside, and some of these more aggressive targets that are the big firms are coming out with now, if that's going to happen, I can all but assure you they're going to step in and start buying these BDCs and turn that sector around. One, let me just play devil's advocate. It's not devil's advocate, it's just hard facts. One of the things that I think could support that case are much higher highs. AI cannot carry the market forever, that I can tell you. That's similar to the dot-com bubble, where one sector was going up, especially AI, now that things have become circular. And it's, like I said, once the flows go the other way, once all that CapEx spending from the Microsofts and Alphabets of the world and Metas of the world, once that slows down, NVIDIA slows down, then they cut back their self-funding right now, going money to OpenAI and other companies and AMD now. So again, that trade will reverse at some point in time. How fast it reverses and how long, yet to be seen. Again, I'm giving you some long-term targets on the charts, but let me tell you what could support gains into year-end and beyond, and that would be just healthy rolling recessions or sector rotation, if you will, and we have seen that. And so sometimes some of the best bull markets that go up and just defy, don't stop where people think they should because they see one thing falling, and I'm going to acknowledge that. Maybe BDCs are just having a correction and money will come back into there, and that sector will pick up, and then AI or something else, or you pick your sector, whatever it is, energy, that has a correction. We've seen that. We've seen plenty of rolling, if you want to call them bear markets or corrections, in many other sectors, and that can keep the markets going for a while because it lets hot air out of one area of the market. A little bit of hot air reprices things back to attractive valuations, and then they move on to the next one. So, and that's also, as you notice, a lot of long trade ideas are these kind of, hey, what out of the blue, we're trading, we're long firearm makers, we're long Pepsi, we're in and out, and pharmaceutical companies and Churchill Downs, it's, the casinos have been longer term bearish, but we went on that. That was a very profitable long earlier in the year. So that's I'm just looking wherever the opportunities are, and a lot of kind of get in, get out, hit and run, milk the quick 20, 30, 40%, and then move on to the next one. So there it is. So we're going to go over some of those. Well, let's do that now, and then I'll get to the next one. I definitely want to talk on the VIX because I've been talking on that quite a bit lately. So the BDCs, again, I like to pull up BIZD as a proxy. And I've talked about this quite a bit, so let's not do too much here, but how we had the last rate cutting cycle that started last year, and unlike this time. So again, I'm taking away what I've heard cited as an excuse for money coming out, fact that they have a lot of, quite a bit of those loans are adjustable rate, but we didn't see that here. We started big back in September of 2024 with a big 50 basis point cut, followed by two additional back-to-back cuts at each of the next two meetings. And so this sector liked it back then. So what's going on here? As I said, and maybe I'm wrong on the reasons, but as I said, when TriCircle filed for bankruptcy, something is going to give if I'm right, and they are under or overstating is generally. And again, it could be one small pocket. There's a lot, private equity or private credit, they can loan to any sector. As AI is getting bigger and bigger. You can have, as long as it's not a tiny little obscure sector that doesn't make a big difference. But if it is a sector related, let's say things related to Tricolor. I mean, Carvana comes to mind, and this is all segueing and it's going to come together. That's another question that was put to me, an update on Carvana. And it makes me think of a company that has been, by many people, kind of accuse them of cooking the books and playing a little sleight of hand shell game there with their numbers. But again, we'll get into that one second. So with that all being said, you do have to acknowledge something is amiss here. we saw this when everyone thought the world was going to come to an end, back when Trump stepped up the podium and announced massive tariffs, and stock markets were crashing, global markets around the world. All right, so that made sense back then. Why are we falling nearly at the same rate? And again, it's an accelerating thing. I always talk about that when I give you, whether it's a stock market or a crypto or a certain commodity, I give levels, and if and as each level are taken out, that's going to increase. The odds are going to go down to the next one. In some cases, you start building, you start accelerating the drop. And right now, this is a pretty hefty sell-off. So again, I think there's something rotten in the state of Denmark. Something here, and you won't read about it. It won't make the papers until it becomes clear to all. What happens is insider trading is and always has been prevalent in the markets. There's legal insider trading by the definition. Insiders can sell their shares, but then there's also the legal, which is it's like petty theft or shoplifting. They're only going to catch a small fraction of it. It's going to go on all the time. Somebody works in a company, they tell their cousin, their brother, their friend, whoever else, and it's prevalent. So you got to just ask yourself, why is this happening? And again, all right, let me move on to some of the individual components here. So now on what I said to Kevin, or whoever wants to take this, yeah, a lot of this is really good support right here. Really good support. PPO is about to turn up, make a bullish crossover. We are oversold, just like we're oversold here. We are oversold here. We are oversold here. Those were the last 1, 2, 3 oversold times. Again, what'll happen, it works great in a bull market. I've always said this. Buying oversold in a bull market is usually one and done. What I mean by that is that in a bull market, overbought is not one and done. It tends to become more overbought or stay overbought for an extended period of time. But in a bear market, usually kiss that 30 level. A bull market, and you're off to the races. So, however, this is sort of telling us something as well. This is not one and done anymore. So this is saying, what's going on? Why didn't they step in and buy the first oversold reading again? So you can step in. It's certainly catching a falling knife, but if you do it strategically or tactically, buy support with a stop somewhat below. I like to always allow for what I call momentum-fueled overshoot. Like when you're heading straight down, there's a lot of downside momentum. You'll tend to often overshoot briefly that level. So what can help is set your stop a little below it and use maybe a daily or a 2-day closing basis below that level. I will say you do have to be careful when things are in free fall. If things are breaking in the sector, then you can continue to see it go down through there. And that's where a daily close or a weekly close can kill it. It can, you can be stopped out 20% below where your intended stop was supposed to be. So let me just rifle through the rest of them so you can see my charts. You can see there's levels. Those that aren't at support are coming up on support, potential selling climax. Maybe it's just rotation out of this sector. I don't know. But again, I'm watching it because I think it could be something else. All right, that's it. Nice support there. BX. Hopefully you can see these. Let me know in the comments section. I assume if you're using a decent quality monitor and your brightness is turned up, you should be able to see what I'm seeing. The ticker symbol and the name of the company, BXSL. Coming up more of a support zone from about 25.92 down to 25.22. Volume is very capitulatory, indicative of a selling climax. But again, if a sector is blowing up, it can go a lot lower. You get that kind of vicious cycle going that, again, because once these loans, I used that analogy before, if you live on a island off the coast of somewhere miles and miles away from the mainland, and you're looking at your Z estimate, and all of a sudden you hear that, let's say there's a huge real estate correction in the U.S. and prices are going down, but you haven't seen it in your market because nothing has sold to reset for the last year, 2 years. And all of a sudden, the house next door to you sells for 30% less than you thought it was, or Zillow had it priced at. Now there's a reset in the neighborhood. Realtors, you know this. If you bought a home, you know this. It's called comps, comparisons. They look at other houses and that doing boom, instantly in very sharp resets the prices. Whereas in the stock market, you're trading every day. So stock prices, even though they can fall quick or go up quick, they trade minute by minute, second by second. So there's that complete transparency and instant, if you will, instantaneous resetting. All right, so Keep that in mind. That could be what's going on in the private credit sector. That's some of these loans, and then selling begets more selling. If a company becomes distressed, they have to sell a loan that they might have been marking up 95 cents on the dollar, a dollar on the dollar, and all of a sudden they're forced to liquidate for redemptions, or they have liquidity issues, and now they have to sell it, and they find out, they put the bid out there, no takers at 95 cents on the dollar. All right, let's get this loan off the books. Let's drop it to 90, 85, 80. All of a sudden it sells at 70 cents on the dollar. And so overnight, whatever percentage of their portfolio that represent, they just took a 30% loss, literally, and that's how that whole thing works, and that's how the financials work, and that's why the financial crisis unwound so quickly back in 2007, started in '07 into '08, and then all of a sudden they realized that selling beget more selling, margin calls were being issued, and then this junk, the CDOs, it had the junk mortgages in there along with the higher quality tranches and all that good stuff. It started to surface, and they could no longer hide those losses. So anyway, so here it is at Main Street. Main Street's just coming off a divergent high. You know me, I'd rather be a bottom picker in the sector. Those that are coming up on support, very oversold. Also know that those may be the ones that have a problem. There's FSK, as I mentioned. This one already took out the Trump liquidation day, panic sell-off lows by quite a bit. There's something wrong, and this is FSKKR Capital Corp right here, 37% down just a few weeks. And look, nice technicals too on this thing. Look at this bear flag, guys. This is a textbook bear flag continuation pattern. You get a drop called a flagpole, very impulsive, nearly straight down, followed by a area on declining volume, a rise, a bounce, and then a breakdown of the flag with an roughly equal drop, just as impulsive out of there. So yeah, it's pretty much run its course too. I did a rough measurement on the target. And so if you want to try to catch a falling knife, you can get rewarded. I love those falling knife trades. I have my concerns that this could be the start of the cracks in the financial system that pretty much no one else is warning about now. So I'll get into my whole gray swan thing in a minute here. All right, this one's at support, GBDC support. No divergence, but it doesn't matter. You don't always have divergence. Very oversold. HTGC, Hercules Capital, just breaking down. That's a divergent high right there. There was a divergent high. So this has been stair-stepping lower, trendline break under the 200s now, heading lower. And again, look what I'm talking about here. We're starting to see some acceleration that tells me these cracks are getting larger in this sector. And I don't think it's just healthy sector rotation. Again, there's I've yet to hear a valid reason for such impulsive selling. This one's at support, TSLX. Look at that, nice. This is an uptrend line. Have one violation again, but if you look at how well it was defined before that, and this is kind of a wonkiness in the charts due to Trump's liquidation day, there's some little shakeout move in the markets, but we're back to that now. Now, if it breaks that, you can see, next support's down there. PSEC, Prospect Capital. And you'd have to look into these. This is when I load the ETF, it shows me these are the holdings. I don't know if they're accurate. It's whatever this charting platform has been fed as far as the holdings. So you want to check into these, see what they're in, do a little due diligence on them. There's one with a divergent low, but there's no support. It's at a 52-week low. This is a stock in a bear market. Could be headed to zero. So you'll be catching a falling knife. I can tell you positive divergence. And again, what's wrong with this company? How are they not making money in this great bull market? They're down 72% off their peak in 2021, the clear bear market. CSWC starting to, again, this rapid acceleration. For those that haven't broken down, those that were kind of holding up are starting to really come under some pretty heavy selling pressure. I'm going to move that line up. It's right now. Why did I do that? It's almost today perfectly right there. I did that because these are two major reaction lows right there. And again, if you kind of almost have to, on a lot of stocks, exclude what happened here because it was so quick. And by the time they realized Trump's full of shit, talking a big talk, and that he wouldn't do 300% tariffs to China like I said he wouldn't do, and that they would cow down, there'd be extensions and all that. That's where the market did. So, again, kind of exclude that, but know that it is relevant, and that for any of these stocks that start getting into that area, what's going on again with how are they not making money? There must be something fundamentally happening there. This seems a little bit more than just healthy sector rotation out of these guys. Again, they've been trending down, and they were supposed to be the next big thing. Private credit and private equity. All the talks about putting them in 401ks. That's a massive market, and yet they're going the other way. OSCL. Look at that, nice. More than a falling wedge, more of a descending triangle pattern. If it goes a little lower, you'd have a falling wedge pattern, positive divergence, but there's a trend line. You want to clear buy signals. It's going to take a while for it to get there. You need to break that trend line, but look at this thing, well below its 200-day moving averages. MFIC, Midcap Financial Investment Corp. Again, this was nice support. Again, just kind of check that off for a little bit. Now, that's relevant. Look, I mean, that's where this stock has fallen for years. This is the trough right there. And it happened during that meltdown. But this is a support level that's been holding here. You can see we had support here. Couldn't get through there. There was a trading range. It just broke down. There's really no support. I don't have any support. Sure, I could try to squeeze in a little micro level, but I don't see much. And so the way this looks to me, if it bounces back to that 12-ish level, that's an objective short entry with a stop somewhat above it. You could try shorting it here. I don't know. A lot of these, remember, we're already down. We've already exceeded my third target out of 4. We hit T4. If we go beyond there, it's because the markets are crashing. That if we have a high degree of confidence in on, I'm talking about the ETF. NMFC coming up. If it falls, makes an equal low, you might have positive divergence. Not a reason to buy. There's there's a little bit of support there. All right. Keep in mind, as I'm going through these, as I often do, I'm going to move this over. Here's my list of all the holdings of BIZD. And I have them sorted, as I often do, by market cap. So now we're down to $1 billion. If I go below there, we're under $1 billion. So I'm going to stop there. I'll just rifle through real quick for Kevin or anyone else that's interested in any of these. See if I have these charts marked up. BCSF. Bain Capital, Specialty Finance. It's a big company, but this BDC is a smaller one. Symbol again, BCSF. Coming up on support, pretty good support. It will have, if it makes an equal or marginal new low, positive divergence. So consider trade ideas or consider just something to watch that you might start hearing about in the mainstream media if you haven't already. CGBD, Carlisle Secured Lending, bullish falling wedge pattern, but also, again, just took out big support. And so no signs of reversal, no bottom or anything. And PFLT, positive divergence at support. We have support here about 890, comes all the way back here. We had a trading range, and that was capping the top of that range there. It's support from years back. I don't put as high a weighting, but it's also coming up on those Trump liquidation day lows right there, which are, should be significant lows, as I've said, on a lot of things. Anything that breaks those lows, something's going on. FDUS, it's far from it, but there's big support. All right, that's it. No, nope, there's a few more. TCP Capital, trying to talk fast, get this video over. It's got positive divergence, but not what I call confirmed divergence. Confirmed is once you make a bullish crossover, which, remember, these are momentum indicators down here, the PPO and the RSI. And when they are pointing lower, it's because the stock's falling, the momentum is downward. So I like to see the PPO, which is the blue line, make a cross above that white line called the signal line and effectively put in a higher low. That, to me, is what I call confirmed divergence. Call to buy signal, and quite often when you get those changes in the PPO, they are buy signals. They do indicate a trend change. So you'd at least want to see that, right? Because right now, again, you're just catching a falling knife. If you feel lucky, take a position here, but I can't make a case to buy it. Get a candlestick reversal pattern or be a bullish PPO crossover. I start to see some of these other ones that are at or near support, holding that support, or some of the ones that already just recently broke support come and regain that support. Yeah, that's bullish. Also could be a dead cat bounce. Be careful, that happens in bear markets. All right, so we are almost done. You can see I'm just marking up. These are at the bottom of the list as far as market cap goes, and that's that. Let's move on to the next question. All right. I do like your trade on a rotation in VIX. COT, that's a commitment of traders. Data has supported this rotation since mid-August. However, I wouldn't consider the COT data an inflection point just yet, according to the data that we have. It's a bummer it didn't print last week. So I pulled up the commercials for the S&P 500. Here's the live chart. I think you can pull it up here. Go to, this is just there's many sites out there. Just Google it. This is macro micro, and here's the Dow Jones, the Nasdaq, and I probably should have pulled that one as well. But remember, the VIX works off the S&P 500, so you got to keep that in mind. And so that's the chart that I posted here, because right now, if you're trading the VIX, the S&P is also the broad market. So here's the point. So right now, here's my takeaway on the markets. And I'll try to, after I finish going through these comments, which is only a couple more, get to that and share my thoughts while I'm talking about last week. I said it wouldn't surprise me, if we see a crash, like a big drop in the market this week. So we're on Tuesday. We'll see. Today it was down, but nothing big. It was just a blip. This is, here's what I went on to say. I don't think commercials will be able to reposition fast enough if the market's about to get hit with what will probably be a gray swan event. I'll expand on that in a second. Although from the looks of the charts, we could see a black swan event as soon as well. And so the reason I say that, and again, I'll try to expand on this in a minute, when I look at so many sectors and key stocks, they are setting up, and they've been setting up with just nice big bearish patterns that just need that little nudge where it's not just one sector. Again, sector rotation's healthy, but we could see the financials break down. I mean, the largest sectors in the S&P 500 are tech, then the financials, then the consumer discretionary, communications, and then healthcare. It goes like that. And so you could see a lot of things fall at once, and that's the setup I see in the market. Now, we need those sell signals. I started the day showing you the chart on the earlier video, QQQ. I'll get to that in 1 second as well. But this is what I wanted to say. So I took a look, pulled up the chart. Here it is. I added the black arrow. And this right here, let me change my color to an arrow you can see, blue. We're exactly, or recently, this was I pulled it up, that's the end of March of 2024. We had a Fed meeting. It was, there were no rate changes, but again, it's about what the Fed says. And I'll get to the VIX in 1 second. So I just wanted to show you that clearly this is what it looked just like that. We're at the same level. We're coming off the same level. In fact, that was the March, that low right there, and we started to come up, move back up, and that's what we're doing here. And we're still, we're right at that level before. And you see this little blip right here in the orange line? That's the S&P 500. You know how to read these charts down here. S&P, this is a commitment of traders. And so doesn't look like much, right? Let's go to Mr. VIX. All right, so I added the meeting right here. The announcement was on March 20th. I'm going to zoom in. Let's take it back a little for you. Let's go here. And so we had a little bit of sideways, a little up, a little sideways action. I highlighted that at the time. I even mentioned that. This note I created back then. You can see created on back in 2024, shortly after. That was a post FOMC whipsaw. So we kind of grinded around a little bit. Remember, we're coming off this divergent low. So the VIX was already, just like now, the VIX had put in a divergent low and was starting to rise. The market didn't think much of it, the FOMC meeting. So that means the market probably rallied a little because the VIX was down. And then I measured it out. That was followed by a 71% rally. And the thing is, again, that wasn't a divergent low. This was the last divergent low. So what I went on to say in there, and let me just show you where the VIX is now. Go back. So this time around, we're coming fresh off a divergent low. And again, it's been nothing, no big fireworks. About where we're up a little bit from the most recent FOMC meeting. But this is the level I said I think the VIX is ready to let loose over 1720. And then going back to that, oh yeah, the thing about it is I can make a much stronger bullish case right now, as I have recently with the bullish falling wedges, the divergence, the trend line breaks that we just got starting to get, and on the VIX now than I could back then. And that was for a 71% rally. So as I told you this time around, I'm thinking, ultimately I can see, as I've covered, well into the triple digits if the VIX, if this thing plays out in, by year end, depends how swift and fast the correction comes. We would most likely, we're going to need a gray swan event to get that. And let me expand on that, because I know some of you are probably saying, Randy, what are you talking about? Do you mean black swan event? Okay, I've talked about gray swans in the past. Most people hear black swan events in the stock market. Okay, a gray swan event. Let me show you what it is. This is perplexity. A gray swan event is a known plausible risk with potential serious market impact, but low probability. And such several events could trigger a stock market correction at this time. Some of the most credible, here they are. So these are potential. I've cited all these, and I hadn't had to AI it before. I just did this to kind of show you guys and make sure I'm not missing any. So these are potential gray swan events. And again, the difference is a black swan event, no one knows it's coming. It's kind of out of the blue. COVID, think COVID, all right? Gray swan event, AI tech bubble burst. I've talked about that. And that's it. Again, you can read this. I'm not going to read the whole thing. Sudden Fed policy pivot. Right now, there's a 100% chance at the next meeting rate cut hike probabilities have been going up, but we're in that blackout period. Let's just say when it comes back in, whatever reason, inflation's coming back hotter. Powell wants to, make his stance and doesn't want to cow down to the pressure from Trump anymore. Who knows? It's one of the things, because again, it's something that I think even the most ardent bull will realize is certainly a possibility. They might not think it's going to happen, but it's hard to deny that that's a potential something. So persistent inflation or stagflation, of course, that goes along with it. More persistent or higher inflation is, harder it is for Fed to cut rates. Geopolitical escalation. I mean, I don't know what, a lot of it, I don't know if it makes the mainstream news, but you can see if you follow, I don't have a Truth Social account. I wanted to follow what Trump said just to see what he's saying, but it was forcing cookies and an email address, phone number. I didn't want to give that stuff away. So I have somebody that sends me every time he tweets something out. And I mean, the rhetoric coming from him, we're stepping up. The world's two largest nuclear powers, are starting to, it's starting to get a little tense there. Middle East, I hate to sound callous. They've been blowing each other up for years, but that doesn't really, unless it affects oil prices, then everyone starts to take note. Other than that, the markets are callous to the atrocities going on over there. But if you start getting, China, Russia, and the U.S. Saber rattling, that could do the trick. So I think we'd all agree on that, and we'll see where that goes. And we know Putin and Trump aren't the two most. Say what you want about them. Let me just stop there. Treasury yield spike, rapid increase in the 10-year Treasury yields. Okay, I've been saying that's been one certain, not just possible, but probable event. So to me, it wouldn't even be a gray swan. It would be kind of something that I see as very likely in the coming months. Consumer weakness in the U.S. Deterioration in lower income consumer spending. We know that's already going on, driven by high inflation, weakening job market, or surging household debt. And they say, or, I'd put and, all the above, could rattle retail finance and other real estate stocks. So, all right, and that's other notable gray swan events: loss of dollar reserve status, regulatory legal shocks, AI-driven monetary disruption. I guess some analysts are saying that the central banks might adopt an AI-driven policy regime with unpredictable market impacts. I don't see the Fed doing that anytime soon, but we'll see. Okay, so enough on that. There's the VIX futures I've given you. This is that 6-month, 2-hour candle. So we're peaking above the downtrend line, but really need to pop that 1872 level I told you. Again, divergent low, constructive chart. And you just need that little spark, that little catalyst that can trigger a drop in the stock market, which I'll get to in 1 second. And then you have VIXY, which is also an official proxy if you want to trade it. Where's my targets? I gave you targets. Where did I give them to you? On the 60? Thought I gave them to you on the daily here. Maybe they're hidden back here. Nope. Huh, damn this thing. They just populated. Okay, it was slow to load or something. That's it. There's that buy signal. So that is now an official long trade idea. We have broken. This is the trend line, the chart I gave you a few days ago, saying the buy signal coming a break of the trend line there. And then the next objective entry, and this is where it should start to really perk up, is if it takes out R2, the second resistance level. The trend line was the first resistance level, about $34. And this sucker should rock and roll. As I told you, the upside potential is measured easily into the triple digits. And then that's it. Don't fall in love if it goes the other way. If we have a blow off top, you are not going to be happy holding on to the VIX. Okay, and again, black swan events possible. If we get something, that broils the markets, we could be down really big in one day. Most people won't want to short if the markets are down. The NASDAQ and the S&P are down 3% or more. They'll wait for a bounce. Again, depending on what it is and what it please hear when I say this, most importantly, what it does to the technicals, you may want to short or you may want to hold off. What I mean by that is, let's just hypothetically say comes tomorrow. Well, we already broke down. This is my charts are set regular. Okay, my charts are reflective as of the close, not after hours. So we broke down. There's a sell signal there already. And the way I look at this, like there's on the S&P, the first good support is all the way down here at about 613.51. And on the weekly, we haven't broken down yet. There's my weekly trend line. So that would be a drop of about 8.3%. As long as the drop that we have takes you down below, here, let me reload everything here. We already broke down. I covered this morning. S&P broke down, and we were back testing today, starting to get rejected. So it was an objective short entry, as I said this morning. So any drop now, I don't have support until first support comes in about 662. So, if you drop there, that's 1%. They're probably going to buy at least, we're still in dip buying mode. We're going to remain in dip buying mode until they realize that dip buyers realize that strategy has clearly stopped working. I need to add a level here. I'm sorry, guys. I missed it before. We had a major reaction high there, followed by a reaction low once we broke out and back tested, and we just stopped there today. So take that out tomorrow. Yeah, a little minor support there, but these are the levels. And let me go to QQQ. Okay, so I added the only thing I've done different since this morning. Yeah, this chart program's getting wonky. Sometimes when I record these videos, it does something to the computer, this program. It takes a while to load them. Let me click back here and go back to my daily. These trend lines have shifted. Come on, chart. Okay, fix it. All right, so there's an example. If we were here, I'm just going to hand draw this in and try to give you an example of what I was talking about. If this wedge looked like this, and this is still our uptrend line, but we closed right here today, and then tomorrow we're down 3%, but we're down right to the trend line. No, you don't short that drop because that's a drop to support. Bulls are most likely going to buy a pullback to support. You either wait for it to break. Well, if it bounces and the trend line holds, so you wait for a break below that. So right now today, this is live. The markets are closed, but we dropped right down to that trend line I started the day at. Look, we parked right on that sucker. So if we break down tomorrow, remember, SPY, I already have breaking down today, but as I often say, even though VIX futures are based off the S&P 500, if they buy the NASDAQ up here off this trend line and hold support, that breakdown in SPY will probably prove to be a false breakdown or whipsaw. So I like to see both QQQ and SPY to break down if and when they do. And if that happens tomorrow or 3 months from now, I will add, won't have the same VIX position, but if it happens, let's say 2 days from now or tomorrow, I will add to my VIX longs. That's what I'm trying to tell you there. And then on the daily chart, I don't really have much support on QQQ. There's some minor support, but 583.45. So it could be a quick run down there too. That'd be about a 3.25% drop. So there's that example. There's another example right there. 3% drop's going to take you right down to this level, which was the previous all-time highs, followed by a breakout and a successful back test. So I would put very good odds that if that did happen tomorrow, this week, anytime, 3%, it doesn't happen in a single day. We drop there. We're also going to hit the 50-day moving average. See that yellow line right here? That's the 50-day moving average. Boom, they came in and bought it there perfectly, and that's dual support. So they will most likely buy a 3% drop there. However, if we were to drop 5% on a black swan event, that's going to take you down through that level, and then you could keep going. Okay, hopefully that makes sense to you. Always check the levels. Sometimes, I often say this, a big up or down move in the market, to me, can absolutely have no meaning technically if there's no support resistance broken, tested, or it can have a big impact if it's a 3% move that is a powerful breakout above a resistance level or a bullish chart pattern or key moving averages, or on the flip side if it's a breakdown. So I always look at what's going on, what are the markets doing, what are the market leading stocks doing at that time. Do I want to act on that or sit tight? George, GeoTrader going long. Randy, can you please update Carvana short? All right, this is Carvana short. Sure, it's about flat from the original entry. We shorted Carvana right here on the breakdown of this trend line. So far, our stop is well placed. I'll give you a stop on a daily close above 400, and that's yet to happen. And now I have this secondary trend line, which also, just like the S&P 500, here, let me go to the live chart of Carvana where I can zoom in a little more. It comes in with the 50-day moving average. So that's CVNA, Carvana. Turn off all the lines. You can see that 50. Boy, they love to buy the 50s, don't they? Right? So support. If you are very bullish right now on this on the stock market or Carvana, you buy Carvana right here. You're at double support. You're at the 50-day moving average, which every single dip for months now, they've bought it up. And you also have that uptrend line I gave you right here, coming off that same low when they started buying the 50s. However, this is an active short trade, so my reply to that question is the next objective short entry and add-on, if you took it on that breakdown, would be a break below this level. Pretty much today's lows. You'll have taken out both the uptrend line and the 50-day moving average, increasing the odds are going to go down to T1. On Carvana, I do think it has a lot of downside potential. Let's just take a look again when I load a stock. Just like when I load an ETF, it'll show me the components. When I load a stock, it'll give me the other components, other stocks in that sector. These are auto and truck dealerships. So let's just take a little ride through there. Why did I do that? Because I don't want to short a stock in a very strong sector that has, 90% of the stocks look clearly bullish, and I can't make a case to short them either. So here's in the order of market cap, Carvana's at the top, then PAG, which is Penske Automotive Group, wedge trendline breakdown right there. That was a divergent high. Hit my first target. I guess I gave this to you as a short trade. When did I do that? Back on 9/11. So that's it. Hit the first target the other day. Bounced. I didn't have an alert set on it, so that one hit. What had happened when it hit T1? It bounced. And now what happens? Next sell signal when it takes out T1. I would say go a little lower because we slightly undercut that 164.75 support. But you also see the 200 days coming in here, although that's sliced through the 200s. I don't put a high weighting on a stock that keeps slicing through it. Price support's a better indicator to me. And there's your next target. What I'm doing here again is going over how the other auto stocks look. AutoNation put in a divergent high. And remember, these are the strongest. There's a lot that look a lot worse. I've highlighted those recently. On AutoNation, I'm going to put an additional trend line right here, a nice clean trend line. Consider this a short setup with a sell signal to come on a break of that trend line that comes off that April low right there, the key April lows. And yeah, lots of downside on these auto stocks. LAD, KMX, CarMax, I've covered this one. Threw it out in a video as a bounce trade, hit that first target, but it's in a bear market. And then after the first target, boom, earnings induced smackdown. And so this is the state of the auto sector right now. GPI flirting right now in double support, 200 days, and that nice clean uptrend line. I can extend that uptrend line, goes back a ways too. So there's a sell signal to come on a break of that trend line, or again, pretty much a break of today's lows. Triple top high, all divergent highs, divergent high, drop, divergent high, drop, divergent high, drop. Just needs to break this trend line. ABG, Ashbury Automotive, RUSHA, Rush Enterprises, just broke down, sell signal there. Breakdown. This one is CARG, Car Gurus. Just broke down this little minor trend line here, still above the 200s. KAR, which is Open Lane Inc., just broke down recently. So this is why I do these videos, guys. I know they're long-winded, but they can cover it. It gives me more confidence in the Carvana short now that I'm seeing a lot. The majority of other dealers breaking down currently on sell signals are very close to being. And so the more stocks in a sector that break down, it just tells you what's going on. It speaks to the strength of the economy. If the economy was hunky-dory, supporting a stock market at all-time highs, people would be buying cars. And we know what's happening. The rich are getting richer, but they're the 10%. They have all the money and, majority of the NVIDIA shares and everything and private investment and all this other stuff. Whereas, unfortunately, although the majority of the people in this country, have most of the wealth and they can't drive the economy. Consumer spending is 70%, but there's so many more of the have-nots than the haves that when the have-nots are suffering, which they are, they're not buying cars. And the cars they are buying, just like Tricolor failed, they're not making their damn payments. So that's where I'm seeing that. I track those, delinquency rates and on all different types of loans. And we know what the majority of consumers are doing. So if you're well-to-do, and most people following this site have a stock portfolio, so they're, you're of the haves, but the rest of the world is not doing, or the rest of the country is not doing so great. And that's, again, reflected in the stock prices of these auto dealerships. Like ACV auctions, what's going on? They're not, not making a lot of money, not selling a lot of cars. Camping World, so that's Camping World's RVs, but that's also a tell. That's a tell on dispensable income. Stock market's booming. Everyone wants to buy an RV and travel around the country, right? All right, I'll move on. You can see cars.com. That's kind of the overview of the sector. So CarMart, look at this. CarMart heading down to, looks like one of the BDCs right now. Okay, and then that was it. Last one, closing market recap. Prepare tomorrow. Absolutely. It only takes one of you out there. If one person wants an update on a trade, that's it. I'll give it to you. I'm glad. That's what I'm here for. So that's why I'm doing this update. And then to end it real quick, just to show you what I was talking about before, how everything's kind of stacked. Remember, I showed you QQQ right on the trend line. This is XLK, which pretty much mirrors QQQ. It's the tech sector ETF. Remember, tech is by far, without a close second, the largest sector in the S&P 500, making up over a third of it. And so it's all about tech. That's just grown larger in recent years. And so when that tech bubble pops, it's going to be very powerful to the downside. However, look at this beautiful uptrend line. So set a price alert. If QQQ breaks, XLK will break, and then you have a sell signal on the largest sector in the S&P 500, and of course the NASDAQ, it's even half of the NASDAQ. XLF, as I mentioned, this is the financial sector ETF. You can see that's my daily chart. Here's my weekly chart. Just big divergences, just like here. And everybody thought the financials would go up forever and the market would go up forever. And then one day it just stopped going up and it started going down. The divergences played out. They're not a sell signal, just an indication that momentum's waning and the trend reversal is likely, and then you get it. And on this one, we had a trend line. We really got it. This was the trend line right here, I believe. That was the breakdown, back test, and it's been moving sideways since. And the big number that should do the trick is about 53. We start getting into earnings season next week, where it really starts heating up, and the financials are usually up front, big banks. So we should know no later than next week if the financials are going to continue to help support the market or take it down. XLY, third largest sector at about 11%. Consumer discretionary, but really this is just mostly Amazon, Tesla, and then mostly Amazon, and then Tesla, Home Depot, Nike in there. This is on a clear sell signal. Breakdown, back test, and now starting to roll over. All right, after making a double top divergent high, nice big divergence, just like we had divergence there. And so that's one of the sectors in there. XLC communication sector, which is just really Meta and Alphabet are the big ones in there. They make up. I haven't updated this in a couple years back in 2022, at the end of 2022. Those two stocks alone, Alphabet and Meta, made up 38% of the sector. But they matter, and that's the thing. They're the ones that lifted the market up for last couple of years. And when they finally roll over and go the other way, they're going to take the market down with it kicking and screaming. Unless this is just healthy sector rotation. But it's a clear sell signal. That's a nice clean up trend line. One violation, I think that was, I forget what was that, something happened that day, earnings on one of the big ones. But we're clearly below that trend right now, and that puts that sector on a sell signal. XLV, healthcare, now it's only about 9% weighting. I gave you targets back here. I told you in recent videos back earlier this year, it was, in my opinion, the most bullish of the sectors with my kind of style. Not to say that AI and NVIDIA and tech didn't go up. They're wedging higher, and they're showing signs of a likely reversal. This one, you had a divergent low, nice, constructive, my kind of chart. We hit T1, 2, 3, and just recently hit my fourth and final target. It's a little above it now. I don't have much of an opinion on it. It's also a defensive sector. I can't make a case to short it either. It's oversold, so it's probably going to consolidate or correct, but no divergence. And again, it's not going to move the needle on the S&P as much. And if tech does roll over, this is a sector where, and we've already seen it, sector rotation. That's a healthy thing in the market. But you also see money moving into defensive issues like healthcare and consumer staples when the odds of a recession start to really ramp up. That's what institutions do. The smart money knows people are going to keep getting sick and going to the hospital and buying Tylenol despite, well, maybe not so many pregnant mothers now, but you know what I'm saying. And same thing with utility stocks. You keep paying your electric bill. Although utilities are really overhyped too. And again, they're tied in now, believe it or not, to the AI bubble because of huge energy demand. So that's a kind of a vicious cycle. Right now it's going one way. When that vicious cycle begins to reverse and go the other way, this is industrials, by the way. There's the trend line we need to take out. There's your divergent high. And again, all I have to do is move the first down markers because it scored a first down with a marginal new, but still divergent high, bearish engulfing candle today in that sector, just like we put in Tesla the other day. XLP, consumer staples, broke down recently below my uptrend line off the lows, following a big divergent high. Energy, and again, these guys don't move the needle, so energy can go to the moon and back. It used to be really big in the S&P. Now it's only about less than a 3% weighting. So, and again, it's just been kind of moving sideways. That's why I haven't done a lot of updates on the sector, just the raw commodities, crude and nat gas. And utilities, again, AI bubble beneficiaries. I mean, it's real if it continues and they build out and they continue to build as many data centers and these chips are still as inefficient as they are. It was that, remember, DeepSeek thing from China, where it could run this, much more efficiently on the chips. I think that'll be somewhere in the future. AI, as I said, is just an iteration of the technology we currently have and processing power. It takes a lot more processing power. And again, when the AI bubble finally pops, again, it will be a hard pop or a soft pop, slow roll. Then the hot arrow come out of the utilities. But it doesn't matter because they're only a 2.3% weighting in the S&P 500. So utilities could fall on their face, and it's not going to move the S&P much. Last trade I gave you, I guess, was back here. Short out that divergent high, hit my first and second target. We were headed to T3, but posted on the April 7th morning of. Time to cover all shorts and go full long. So that was a truncated trade as well. So ultimately, we'll probably get down back to that T3 level. Okay, so that concludes the video. And again, kind of the takeaway with the charts being stacked and the whole reason, like I said, it could take one single event. If tech breaks down, you have the financials right behind it too. Everything's poised for that reversal. And as I showed you, and thank you, for the person brought up the commitment of traders. I've covered the skew recently, the skew index, which is a kind of almost a black swanish event type thing. It's similar to the VIX. That being at levels that have preceded other market drops. Put to call ratios coming off historical low levels, short interest. So it's all there. All the ingredients are there. You just need a catalyst. And again, this market buying begets more buying when there's a FOMO trade going on. And if and when it goes the other way, and what's going to take it going the other way other than a fundamental catalyst, like I said, a gray swan or whatever, simply sometimes it'll just collapse on its own weight. You start breaking support levels, and that's what does the trick. And then the news headlines will follow later on, though. I promise you, I've always said this, CNBC and Bloomberg and all the financial media, they will always slap on a headline to account for any big rise or fall in the market, even if it's the most asinine reason. That's what they do. They never put their hands up in there and said, we don't know why the Dow's down 1,000 points today. They'll blame it on a shift in Fed rate policy expectations, or I don't know. You pick the reason, de jour. All that I can do is trade off the charts, and then I just showed the levels to watch and the things that stand out to me. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.